to the supplement from the 12th of January 2025, and this week's efforts are called Come On Rachel. Now, if you've listened before, you'll know that I like to start with a quote, and this week's is in the form of some song lyrics, but don't worry, I'm not going to sing them, but they're from the famous song If You Leave Me Now by Chicago. So if you leave me now, you'll take away the biggest part of me. Ooh, sorry, I promised, didn't I? No, Rachel, please don't go. And that's my amended version there. And that's with reference to Rachel Reeves' trip to China, but also overall to the pressure under which she's under and the call, certainly in some parts of the media, for her to resign or be sacked. So before I get started in earnest, I want to know if you want to kickstart your 2025 by joining a group of property investors and developers who are committed to moving forward this year. Boardroom Club, that I've run alongside Rod Turner for over 4 years now, has one more spot available, and if you're in property operating at a level below the one you know you can achieve or want to achieve, Boardroom Club may well be that thing that gets you to level up. We meet monthly on the second Wednesday, 9 times a year on Zoom, 3 times a year face-to-face. We have one-to-one calls once a month as well, and WhatsApp support when it's needed. We've welcomed investors, developers, traders, brokers, people with property businesses, people with non-property businesses, and we continue to do so. And if you'd like a no-obligation chat about Boardroom Club, drop me or Rod a message on LinkedIn. My LinkedIn can be found at linkedin.com/Ian/Adam G. Lawrence. And even if you're not interested in Boardroom Club, make sure you connect with me on LinkedIn anyway. So welcome to the supplement, already on the second one of 2025. And today I'm going to get stuck right into the real take on bond yields and what's going on with the rates and where we sit as at today, changing a bit too quickly for anyone's liking, but a long way away from a crisis as yet. It's also time to look at some on-the-ground data as well, and the thoughts of UK finance on the mortgage market for 2025, particularly in buy-to-let. Now, in the real-time slot, don't forget my conclusion from Chris's work last week, that self-employed agents are likely to do a better job for you selling a property than larger corporates with structures that fragment the responsibility for valuing, listing and selling. The percentages are compelling, and the self-employed model, as an average, is doing a 13% better job, which means a real bottom-line impact when you sell anything. That doesn't mean a self-employed agent is automatically better, so you still need to qualify these people, folks. And until the property market stats come back from Chris, I wanted to use the rest of this slot this week to share my real-time insights and what the industry press are saying. There's a strange press release this week that I've seen a few times that suggests landlords might cut prices to meet the stamp duty deadline, presumably in fear that prices will go down even further after April. Well, that would make sense if prices were going down, but they're not. Even the negative feeling around our Chancellor at the moment isn't impacting what I'm seeing on the ground in the housing market. Confidence is low in the business community, sure, but in the house buyers, they're just getting on with it, as they always do. We have the RICS residential market report next week. That might tell a different story, but I'm not expecting it to. And December's report isn't worth that much anyway, given half the industry gives up halfway before December, when we're less than 2 weeks in, normally. Buyer confidence is rising. People are, indeed, keeping calm and carrying on. The long-dated gilts are not looking good, but this has not yet bled into really infecting the 5-year and 2-year money, which is what props up our mortgage market. And there's some more on that later on, of course. Now, auction catalogues are thinner than I would have expected, and things are looking a bit overpriced. And that suggests confident auction houses, or vendors holding their ground, or even the bleeding stopping in the disposal of properties, although I'm not expecting that anytime soon with the Renters' Rights Bill in the offing. Remember, a huge number of landlords have not even heard about it yet, let alone taken any time to understand the implications of it. A quick look across the main industry websites for property, agency and landlords reveals the following. One lunatic predicting interest rates will fall to 2.75% this year. And this is such a silly prediction. There's genuinely no path to this being the interest rate at the end of 2025. 0.5%, sure, there's a path, a bad one, but 0.5% is more likely than 2.75%. Okay, rant over. Buyer confidence is growing. One lone MP calling for rent controls. A call to stop the end of rent up front in the Renters' Rights Bill, because at the moment they're going to bring an end to being able the ability to take more than 1 month's rent up front. Knowledge gaps over the cost of EPC improvements. No kidding. Estate agents cutting asking prices. I look forward to that. That's the whistle-stop tour of the industry press anyway. So that's a bit of a different take on the real-time market stats, and we should be back to business as usual next week when Chris returns in full. Macro warms up a little, but next week is when the temperature really goes up. We'll have inflation, we'll have growth, etc. This week we've got the final PMIs. Now, insert a meme of the economy hanging onto a cliff edge here. We've got the Halifax and their final figures for 2024, and we've got the BBA mortgage rate to report on. I'm going to use the relatively paucity of need for analysis to also tack the Bank of England decision maker panel onto this section, which we haven't really examined in detail before. And then we have to end with the gilts and swaps. There's zero sign of my interest in those markets letting up. Quite the opposite at the moment, in fact. PMIs are my darlings of real-time economic information. They're not perfect. The economy, for example, should not really be shrinking at the moment, according to the PMIs. It should be just about holding on. However, paucity of data can be misleading, much more so since the pandemic. It's a real problem at the ONS, and growth is therefore often revised, lest we forget, as more data comes in. Anyway, remember, these are from the purchasing managers at the very biggest companies in the UK. That in itself may not tell a story of misery in SMEs, which is another reason why PMIs and economic growth may not correlate perfectly. This sweep also includes the KPMG REC report on jobs, because of the timing this January. That headline is not fun reading in the jobs report. Permanent placements and vacancies fall at accelerated rates in December. Cost concerns and redundancies already being reported. This cycle is moving quite quickly. Brighter, pay continues to rise for high quality candidates. Staff availability increases to the greatest degree in 6 months. A traditional English sandwich with decent filling and terrible quality bread there. These reports were not that great in early 2024 either, when alarm bells were sounded. Let's bear that in mind. However, businesses desperately need confidence, and they have none right now. The chief exec of KPMG comments on these reports. It's muted, biggest vacancy contraction since August 2020. Hiring intention declining at a pace not seen in 16 months. It's caution plus slower rate cuts than people were told. Businesses still need new talent, and salary inflation was at a 4-month high. His last sentence was the most telling, although of course he's talking KPMG's book here. Chief execs will certainly be counting on new policies which will support their 2025 growth ambitions and boost confidence to invest. Now, the REC chief exec was more positive, pointing out that December's always like this, although clearly not always as bad as this, as evidenced by worst figures for 4.5 years and things like that. But it's what happens in January that defines the path ahead. And this is very true and a good challenge. He points out that sentiment can change quickly, which it definitely can, and it has, some would say. He points to inflation under control. I would just temper that with ish, although the 3% plus level suits us okay, as long as it stays under 4% in my view. Low unemployment, which will remain true even if it goes up to 5%. That's still low. And economic growth expected. Well, I do expect it, but I expect it to be half of what's been predicted, and that's a problem. The bigger PMIs then. Services first, the big one. The flash was 51.4 back in December. The final print is 51.1, which is another little disappointment. Still in front of the 50 though, and the Composite Index stays at 50.4 instead of 50.5. Best estimate for December, 0% growth on the back of that. The headlines are similar to the job report. Fastest rate of job shedding for nearly 4 years. Employment declines for the 3rd month in a row. Marginal increase in business activity. Input cost inflation accelerates to an 8-month high. Even less of a nice filling in that sandwich right there, like one thin slice of processed cheese or similar. That composite reading of 50.4 is the lowest composite reading since October 2023. The economics director at S&P Global Market Intelligence had a few comments. 2024 ending with a near stalling of incoming new work, a marginal upturn in business activity, an overall considerable loss of momentum and failing business confidence. True. And consumer confidence. We've got mixed reports on that front though. He uses the term post-budget slump, which is pretty serious. Rising payroll costs and an overall unease about the climate for business investment are the cited issues. rising input price inflation, cost pressures reaching an 8-month high, and intensification of prices charged pressures. 1 in 4 survey respondents saw an overall decline in their payroll numbers. If you exclude the pandemic, which you should, this is the steepest pace of job shedding for 15 years. Let's pause for a moment because that's massive. You can almost ignore 15 years ago, the eve of the concerns of a double dip recession and an economy reeling from a financial crisis. You could argue this economy is reeling from a pandemic, but at the moment this all feels very self-inflicted indeed. The unemployment numbers will be going up this year, folks, higher than predicted. I'd now be surprised if we don't see something touching 5%. Services are so very important and employ so many of the people in our economy. So that's cheered everyone up. The most gloomy report that a positive print in the Composite Index could possibly be, I think. Construction looks a little better, although with caveats. The print, 53.3, is still very healthy, although the lowest in 6 months. Make no mistake, that's a solid upturn in output. House building remains the weakest performing part. The pace of new work is slowing. Business optimism has rebounded from the 13-month November low, though. Much more positive, but not for resi. When you dig deeper, planning applications are down significantly. Starts are down. Output is down. The Building Safety Act is adding 6 months to some builds, apparently. The biggest mistake in the changes there are not phasing them in with years of notice by the sounds of it, which is a significant error. Commercial building is still leading the way, ahead of civils. There's tight labour supply still, as we all know. Subby availability was the lowest improvement in that metric since March 2023, and the rates charged increased at the fastest rate in over 18 months, and that's no fluke. Demand remains a concern, but 48% see expansion this year, and only 15% see a decline. That leaves 37% either on the fence or don't know. There are concerns over budgets, which are correct concerns if we just read the number of local authorities with their own mini black hole situation, a lot caused by temporary accommodation, of course, which is just going to get worse and worse and worse throughout 2025, I'm afraid, as the perfect storm conditions continue. Okay, anyone need a shot of scotch in the second coffee? It's hard to be cheerful, but let me give you an alternative outlook. Someone said to me on LinkedIn this week, "Aren't you sick of these idiots yet?" And my considered answer was, on a personal level, this government has so far provided an incredible amount of opportunity, and my business has had the best time it's ever had. I'm sorry to report that's on the back of people disposing of properties in their thousands, rushing to beat budget deadlines, and ultimately, in my view, in the long run, making bad decisions. But that's what it is. If I was truly evil, I would have voted for these guys if I'd known how bad they were going to be, wouldn't I? But being serious, I try to write and report with self-interest set aside, primarily because I'm interested in what's really going on, rather than working to any sort of agenda. Whatever happens, we need to deal with it and keep calm and carry on, right? So moving on to Halifax and the House Price Index, they printed a 0.2% drop for December, and this ended the year then, according to them, with a 3.3% positive, which is down from their 4.7% positive in November. This is mostly base effects because they had a surprise upturn, surprising them, not me, in December 2023, and so this had to drop into the figures to change things somewhat. Still plus 1.4% on the quarter, so they say. Their head of mortgages always comments, Amanda Bryden speaks of a steady market with growth from the summer onwards. She then cites higher rates knocking people off their perches, often spoken of but almost always overblown when we're talking about relatively small changes, and also when we're talking about a market that is governed by stress tests, not immediate mortgage rates in the now. She also speaks of the stamp duty bumps upcoming and their effect on motivation, of course. Demand outstripping supply in many areas of the country, Bryden tells us. She cites affordability remaining a challenge, I refer you to my stress test comments, and cites employment as a potential dampening factor if unemployment is going to go up, which, as I've said, it will. 1% more cyclical unemployment. It's hard to determine what's cyclical and what's not, but primarily it would be expected that most of the moves would be cyclical. Reduces house prices by about 0.75%, or up to about 0.8, according to research cited by the Bank of England in one of their working papers on this issue. Now that's not the same as house prices dropping, but it is one of the things that is keeping my house price prediction down from where it was in mid-2024, that's for sure. Halifax has the Northwest winning England for 2024, 5.3% up, London up 3.3% last year too. Scotland lost the devolved nations battle, up 2.4%, Wales up 4.6%, and the indefatigable Northern Ireland up 7.4%. Now, Halifax's track record for predictions is so bad, they even leave a figure out of the report this time around, simply predicting modest house price growth this year. I've seen 0 to 3% published elsewhere when they've put a number on it, which it doesn't appear that they have. Now, that's the widest barn door in prediction land, and I still maintain they should be ashamed of themselves for being so bad over the past few years. They've often been 8 to 10% out. Now, this year they won't be. So next up is the BBA mortgage rate. This is, to remind you, the average reversion rate that the big lenders report that their borrowers are paying when they're not in a fixed term. The number is 7.5%, which sounds pretty bad, but right now that's the average buy-to-let yield in the UK, and this has been over 8% in the relatively recent past, the BBA rate, so 7.5 isn't that bad. Frame it as 2.75 over base, maybe, not a terrible margin for a floating rate loan, and it's very much the world that we're in these days. So why don't those that are on that rate just refix? Well, many because they're thinking about selling. They might as well stay flexible instead of paying ERCs. If you can currently fix on about 6% or low 5s in a personal name, then 7.5 isn't too bad, especially because the 6% means fees from solicitors, valuers and the likes, no doubt. I mentioned the DMP data, the Bank of England Decision Makers Panel, and this is a good time to bring that up. It's a survey conducted and published in relatively short order, so relatively real time, just as I like it. Around 2,500 responses thick. In December it was 2,346. Now, firms report on a number of things in this survey. Output prices, up by an average of 3.8% annualised in the final quarter of 2024, down slightly from the 3 months ending November, which were up 3.9%. Year ahead own price inflation, so how much companies think they're going to put their own prices up, to be clear, also expected to be 3.8%. So firms don't see the current rate of price movements going down over the next 12 months, nor do they see them going up, in fairness. Perceived CPI was 2.5%. Expectations for CPI year ahead, 2.8%. 3-year expectations, 2.7%. These expectations are nudging upwards. DMP respondents also reported wage growth of 5.4% annually. They expect 4% 1 year ahead. Historically, they're pretty accurate in these predictions, so that's a pretty safe number to be within 0.5% of either way, probably. Now, the next bit's the most interesting, because in the survey they asked about how most businesses expect to respond to national insurance contributions for employers going up from April. This is a question where they're allowed to select more than one response. They asked that in November's survey and in this one, and here's the average of those responses. 61% expect lower profit margins, 54% expect to raise prices, 53% expect lower employment, and 39% expect to pay lower wages than they otherwise would have done. And that's so interesting on so many levels. If you ideologically believe in what the government has done, which I don't because I believe there's limited room for ideology, then 61% of firms are still going to pay people what they would have paid them anyway. The same number are going to have lower profit margins because the government's taking a bigger slice of the pie yet again, of course. And then more than half will have higher prices and fewer jobs available. Does that all sound worth it? Well, why this is particularly relevant versus some of the other data that the Bank of England uses, like the BBA rate, is that for the BBA rate, only the very largest players are in the sample. Sure, they represent 75 to 80% of all lending that goes on, but the DMP was designed to be representative of the population of UK businesses, and then the results are weighted so that this looks like the business makeup of the UK. This is why these results are very valuable, and exactly why the predictions are often very good, and exactly why I wanted to share them. So that leads me to segue to the gilts and swaps. Our first full week for a few, and not a particularly enjoyable one. A little bit of expansion this week, rather than just focusing on the 5-year gilt and swap, because you might have seen some of the headlines. Highest bond yield since 1998 was one that I saw this week, for example. The next most important gilt to us, apart from the 5-year, is the 2-year, because this is how the mortgage money for 2-year fixes are priced and where the swap rate's derived from. Now, there's been a bit of a journey on the past 2.5 years or so because we've had an inverted yield curve, meaning that more expensive money is shorter term rather than longer term. When the market's functional, it should be the case that locking away money for longer should attract a higher premium because there's more duration risk, as they call it. But when it doesn't, it means the market thinks a recession is coming and rates are going to drop in relatively short order. Because in a recession, the central bank cuts the interest rate to try and stimulate growth in an economy, encouraging people and businesses to borrow and invest in creating future economic growth. Now, in the first week of July 2023, which was where the market high in bond yields came, generally before this week, the 2-year hit a high yield of 5.38%. That's brutal. That would mean 2-year limited company mortgage fixes coming in around 7.5%. This was the time when the really big fees were being levied, 7 or even 10% on a 2-year mortgage sometimes, if you needed to get the rate down to pass the affordability tests. Unsustainable because you couldn't simply trust the properties to grow by 7 or 10% in the following 2 years. And indeed, most won't have grown 7% plus by then, although some will have done. Kicking the can down the road is just not sustainable. This week, the 2-year hit just under 4.6% on the yield. Not even its worst print for 52 weeks, and still a fair way under that 5.38%. So no alarm bells there. Now the 5-year hit 4.6 as well. That's pretty much its 52-week high, but not the cycle high, which was 4.98% back in July 2023. The bonus, if there is one, is that the swaps, which is where the mortgage money is obtained from, still keep trading well under the gilt yield at just under 4.15%. That's what makes our typical what's the cost of debt prediction. So I simply add 2% onto that because that's the typical margin that we see in the buy-to-let space. So the resultant yield from the 6.15% cost of debt that I would consider safe for a normal vanilla residential property is 8.8% at the moment. That's, in my world, the investment grade gross yield. Yields are around 7.5 at the moment, depending on numbers, depending on who you trust, but that means only about 15 or 20% of the residential property in the country right now is investment grade. Now, one swallow doesn't make a summer, and 1 week doesn't finish everyone off. We have to see how this plays out. In the media, particularly the right-wing iterants of the media, this is all the international bond markets treating Rachel Reeves as though she's Liz Truss or Kwasi Kwarteng. Now listen, I'm not the founder member of the Rachel Reeves fan club, even if panic induced by her mere presence has nicked me a few quid, as I've described earlier. However, I am here to be objective and fair, and anyone objective and fair would note that the US 2-year note has steepened this week fairly considerably and is up 10 plus basis points, and their 5-year is similar. The numbers are scarily close, although they did react at different times. Why? Well, the immediate action this week was around a jobs report that was released, although there have been huge revisions downwards to these job report numbers as more data comes out. So that's the immediate knee-jerk reaction of the market. But more broadly and more macro, Trump's policies are inflationary. Anyone level-headed knows that Trump is posturing, and he's posturing like a real pro. However, some of what he says to some extent will be enacted. Deportations, inflationary. Deport illegal workers, replace them with legitimate workers at higher costs. Tariffs, his favoured word. It's a Greek word. Inflationary, because the price of those selected goods selected for tariffs goes up. Borrowing before de facto President Musk enacts the aforementioned Department of Government Efficiency has everyone concerned because the US is spending so very much on servicing their debt. Or, to be more accurate, they're just borrowing more and more and more to theoretically service their debt. Now, the US and the UK bond markets are heavily intertwined, as I've opined in the past. Too much so, in my opinion. Plus, all the reporting that comes out in the UK talks about inflation, inflation, inflation. Indeed, what the Donald and Sir Keir Starmer / Rachel Reeves have in common is inflationary policies. The difference being that the ones in the UK are already enacted, whereas the US ones are still puffery at this time. A quick reality check, though, on why the headlines have been the way they are regarding these all-time highs, and a point on false equivalence. Around the kamikaze budget of 22, yields moved up 2.5% from where they were. They were in the low 2s, they went to the high 4s as discussed, or even higher. An absolutely intergalactic meltdown of a move in the bond markets. In this post-budget cycle, the UK yields have moved around 80 basis points or 0.8%. So the magnitude, comparable magnitude of that move is about 1/3 of what happened after the Truss budget. But of course, those yields have moved from a higher base level upwards because we started in the 3s and went back into the 4s. So that's why we're pushing some of these higher highs. But look, Reeves is not Truss. She's far better than that. But that's like being a man who's taller than me. I'm 5'6.5". Never forget the half. It's a horrifically low bar. The headlines are coming about the longer dated notes. This is long-term confidence in the economy, and it appears there's basically none. The sums don't add up in the long term, and the long-term investors just don't know what to do about that. The current yields being offered are those that really suggest there will be a default in both the US and the UK, in my view. Or, more accurately, there's a significantly live probability of a default in coming decades. Or a devaluation, or something like that. The 30-year UK gilt hit a high at 5.445% this week and closed the week at 5.41% yield. To me, for a UK institution, that looks like a stunning, stunning offering. Any pension fund not tucking into that is either seeing default as a significant probability or does indeed a default is possible during that time frame. Just get your head around that. Anything offering less than 5.41% per year, and you do have to lock the money away for all of that time, over 30 years, has to be less risky than lending it to the government, the greatest UK business of all, with a revenue of 1.1 trillion per year. This matters much, much more in the USA. Their 30s look a little better. They touched 5.005% this week and closed at 4.946. Well, there's not a huge amount in that, of course. Why is it so much more important in the US, though, the 30? Because that's where the mortgage rates are priced from, because they tend to issue 30-year fixed-rate mortgages. So, 0.5% worse than the UK mortgage rates if you compare our 2s and 5s to their 30s. And, of course, the durations are different. But the 30-year SOFR swap, the SOFR swap, which is the best equivalence I can draw to our SONIA swaps, is down at 4.016% happily, which is very close to the same rates as the UK money or a little cheaper, although their margins do tend to be higher in the States. Now, I don't know how long that can stay nearly 1% cheaper than the US bond. I really don't know. I couldn't comment because I'm not an investment banker and I've never been a bond trader. The US touched 5.1 on the 30s in this cycle. Right, the UK is at its cycle high in the 30s as above, but not its cycle high in the 2s or the 5s. So they're closer to their cycle high on the mortgage rates than we are. There's also a lot of focus when they talk about it in the media on the 10-year, because this is the most often traded gilt or bond in either of those markets. That's usually the time frame over which investors, institutions that are buying gilts are thinking. Duration risk is worrying quite a few. Now our 50-year gilts are trading a fair bit lower. They're back under 5% yield. And what message that is sending, again, I'm not clear. So a longer chat this week about the importance of all of this. We're not at panic stations yet. We have checked that the lifeboats have got air, however, and puncture repair kits. Let's call it DEFCON 3. Suboptimal, but not call the Governor of the Bank of England. Make no mistake though, communication out of number 10 and number 11 will be absolutely vital. And I just don't think it's been much good so far. The government also needs time to deliver results because of what they've promised, and the people have no patience. They will fail on the housing target. There are precisely 0 people who think they'll get there that I've met anyway. It's a mathematical impossibility without finding huge amounts of money. I saw a credible estimate this week of what it would take for the government to build 1.5 million homes if you took them literally. It's not what they meant, in my opinion, but it is their fault for framing it in the way that they have. And that number's knocking £375 billion in subsidies. Now, the maths are somewhat complex, and the spends on temporary accommodation means you could perhaps fund 100 billion of it if you had the appetite by issuing index-linked bonds. But issuing linkers, as they're known, when inflation isn't really under control but you can't really tell anyone, is unlikely. And that's just the money. You need the skilled contractors to actually build them, and the sites, and the planning, and the materials, and the professional services. It's not an easy game, this, folks. So, all in all, you can see why Rachel's gone to China to court investment. They will also have different strategic purpose, not strategic purpose we particularly like as a nation, but they'll be less worried about defaults, or even very happy if they happen, because they could swoop in and buy many assets. Let's be careful, just as we would be with a dictator before we send the SAS in to execute everyone. Because who replaces Rachel if she does go? If Reeves goes, Starmer's under huge pressure. She'd have to resign. She couldn't be sacked, otherwise he goes too. Then on the matter of replacement, I'm not sure they've got anyone, have they? Would we turn to the Lords, make Martin Lewis a Lord and whack him in? Stranger things have happened, in the US anyway. John McDonnell's had the whip removed, luckily, so he can still sleep at night. Annalise Dodds, or Minnie McDonnell, the former Shadow Chancellor before Reeves, is still around and wouldn't be ideal for any of us, let me tell you. So, to conclude that rather large segue, I vote we stick with Rachel for now and back her as much as possible. This is a least worst scenario, folks, not an ideal one. While on the subject of possible defaults, though, in the medium term, which, by the way, are one option if we can't shrink the state in at least a couple of ways, most likely by private sector contribution, then perhaps we should take a look at the household balance sheets for the deep dive. 1 month ago, the ONS published their estimates for the national balance sheets for 2024, estimates of financial and non-financial assets for the UK, providing a measure for the nation's wealth. Why is this important? Well, I hear people talk quite a bit about the UK being bankrupt, and I find this helps to put things into perspective. If we say GDP is around £2.7 trillion in today's money, and the national debt's about the same number, we might feel comfortable with a household, this is an analogy we could use, a household creating £100,000 a year with a debt of £100,000. However, if that household also spends more than it earns after deductions and needs to keep borrowing more and more every year, we might feel a lot less comfortable. And that's often what starts levelling the bankruptcy chat. Now, we bring in around 1.1 trillion as a government, that's government revenue, and we spend about 1.2. So that 1.2 does give back to our citizens, however, and generally helps to create more than the 100 billion shortfall in household and business assets not owned by the government. So, system works, send more money. Well, not necessarily, but when I frame it like that, it looks a lot more functional, doesn't it? Now, this is the ONS, and there's a lot of data here that needs multiple revisions. So they call the report 2024, but it's reporting on 2023, but making good on their first guess. So the good news first. The estimated net worth of the UK in 2023 is 12.2 trillion. So if you see the government as the primary business of UK PLC, its entire output, the GDP, the country, is around 22% of said net worth. If you see the tax take as a better measure, that's about 9% of the net wealth of the UK. So that's not terrible when we frame it in that way. So now I can start on the less good news. The number was 12.7 trillion back in 2022. We went backwards in 23. It was 10.8 trillion in 2020, 11.8 trillion in 2021. So there was some nice growth there, but some hefty inflation too, and of course all that stimulus. If we take 2019's 10.5 trillion and use it as that last normal year, as we do quite often these days, and then we inflate by inflation around 20%, which is about right over the time period, and I'm talking about by the end of 2023 to be clear, we would get to 10.2 trillion in 2019 money from 2023's net worth. So we've gone backwards, but not disastrously so since the pandemic. Pandemic's cost us about 300 billion as a nation. Doesn't feel entirely wrong aside from anything else. But look at where those increases came, especially 2021, right? Why? Well, that's what, apart from anything else, the roaring property market does. And indeed in 2023, what a falling property market does. In 2021, over 60% of said net worth was simply land value. Get your head around that one. This breaks down into financial net worth, a negative and a big one. Lost 658.2 billion in 2023. Consider that as net debt, I suppose, as the best analogy to outside the UK. And then financial corporations worth 326.4 billion and households worth 10.9 trillion, which is down from 11.2 trillion in 2022. So in spite of what you might think, from a net worth perspective, the households have the vast majority of the money. And their government, and yes, I know most people don't consider the government to be theirs, especially at the moment, but it is a relatively small beast in comparison. A fair amount of that household money is, to be clear, shares in non-financial corporations, i.e. companies in all sorts of sectors of all sizes, listed and unlisted. And of course, the property. So, at a level of detail, 476 billion was destroyed in 2023, as far as the ONS sees it. Now, we can't blame Liz for all of that, but she's got to carry the can for some of it. The brutal shock to interest rates means that property values did do some correcting, to say the least. It's fair to say that at some point that correction was coming, but the way it came about did not help. So this all breaks back into 6.7 trillion of non-produced assets, as the ONS call them, primarily land, and then 6.2 trillion of produced assets. So the ONS sees land value as having fallen 7.4% in 2023. I know what the developers listening to this will be thinking. Didn't anyone tell the vendors? This was the first negative growth in land value since 2011, and I'm sure was somewhat repaired in 2024. The figure the ONS now uses for 2023 house prices is minus 2.7%. Well, that was their figure in September 24 anyway, which is still subject to revisions. Produced assets were up 7.3%, however, which offset a fair amount of that. Household net worth, the major component and the one we might be most interested in, was down by 2.4%, again primarily due to land values falling. 1.1% of that was explained by a fall in the value of insurance, pension and standardised guarantee schemes, which also took a huge bath in 2022 when household net worth fell, as the government of the time desperately tried to claw back pandemic stimulus by increasing the tax burden significantly. To help make some sense of this, produced assets would include dwellings, other buildings, machinery, intellectual property and cultivated assets. Net financial assets would include gold, money on deposit, physical cash, debt securities, loans, shares, insurance, pensions, derivatives and stock options, and any other accounts receivable or payable. So 2023 was a step backwards. We knew that. You'd expect 2024 did okay, since the property market moved forwards, and that's such a big part of the equation. But don't forget inflation. In real terms, we're still not as well off in aggregate as we were in 2019, and we knew that anyway. This is what the people primarily voted in the election on, in my opinion, in 2024. We've lost years. Arguably, we've nearly lost every year since 2007 on average, but we don't want to lose another one. So we've got money for bailouts if they were needed. You might see, reading that, why I have a total obsession with equity release and the government being a facilitator of equity release. Look at all that money tied up in land, and it is doing really nothing at all when it's unencumbered. I think equity release is a wonderful weapon for inheritance tax planning at an individual level, and at a macro level, it is the biggest missed opportunity of them all. So before I close this week and before everyone has forecastitis, in terms of seeing everyone's predictions for 2025, I did want to fit in UK Finance's forecast for the mortgage market in 2025. They have the very best data because they represent 300 large financial services firms. And they see, in no particular order, lending for house purchase is up 10% on 2024 to 148 billion. Internal product transfers at 254 billion, which would be a 13% increase on 2024. Gross lending at 260 billion, 11% up. External remortgaging, so not product transfers, 76 billion, which would be up 30%. Sounds like competition hotting up for people to move mortgages over. New buy-to-let purchase lending at 9 billion, which would be down 7% on an already anemic 2024 for buy-to-let. Tells you exactly what anybody thinks about the attractiveness of becoming a landlord. And arrears, mortgage arrears in total in terms of number of cases, at 99,000, which would be down 5% on 2024. Now, I wouldn't confidently disagree directly with a lot of that because the source data is tough to find, so I can't read it. But I wouldn't treat it as gospel either. But none of the overall direction of travel strikes me as too far wrong as I can see it. The 10 billion buy-to-let lending achieved in 2024 was a 13% increase on 2023, which tells you what you needed to know. 2023 was a very tough year for buy-to-let. Product transfers and external remortgaging were both down in 2024 compared to 2023, as people gambled on waiting for lower rates or sold off instead of remortgaging or transferring. The other fall in 24 compared to 23, happily, was arrears cases, which were 3% down on 2023. And the overall headline was a gradual recovery after a tough year. So that sounds more like a new normal, particularly for buy-to-let. Although the UK finance forecast is quite up a tick in 2026, this week's image shows that they do see further headwinds and directly cite the 2% extra stamp duty as the reason for the 2025 contraction that they're predicting. No kidding. The actual wording they used, the introduction of an additional 2% stamp duty surcharge announced in the autumn budget, will act as a further deterrent to a market which already faces heightened regulatory and taxation challenges. Whilst the sector continues to adapt to meet these challenges, we do expect buy-to-let purchase activity to contract modestly, 7% to 9 billion in 2025. The primary adaptation, higher rents, of course. The expectation for the significant tick up on remortgages can only be based on the number of mortgages taken in 2021, presumably, which would mature in 2026 when the market was super hot, and there were lots of transactions more than any normal year. The new purchase, as you can see, is bearishly and probably accurately forecasted, very flat indeed. The remaining figures of interest from the report then, 6,300 possessions taken in 2024, that was 31% up on 2024, but far lower than previous cycles. The forecast is for possessions to still trend upwards in 25 and 26, but for arrears cases to go down. And this is very typical in a cyclical way. The moral of the story is fewer cases, but the ones outstanding will have gone on longer and finally worked their way through to possession, which is often quite a slow process. So, as we draw to a close, this will now be the final call. The last few tickets for the next property business workshop are still on sale. Thursday the 16th of January 2025, with some fantastic subject matter, planning, efficiencies, financial accounting and bookkeeping, not how to use Xero, but how to ensure reporting is set up correctly and how to monitor it on an effective, ongoing monthly basis. Come along and get your strategic planning sorted out, and your January kick up the backside comes as part of the package as well. Rod and I hope to see you there, and you can buy a ticket at bit.ly/PBWFIVE. There's also a link in the show notes. And we all know there's only going to be one way to deal with all of this ongoing noise and excitement in 2025. Keep calm, always listen to the supplement, and carry on. Thanks.